And of course, first of all, welcome to this edition of the Pension, Retirement and Aging Seminar Series. Before we begin, I would like to acknowledge the traditional owners and custodians of country throughout Australia and their continuing connection to land, waters and culture. We pay our respects to the elders past, present and emerging, and extend that respect to Aboriginal and Torres Strait Islanders who are present here today. So a couple of ground rules. I think everyone has actually done so. So please mute your audio during the presentation. If you have a question, please use either the raise your hand function or the chat to write your name or question or the actual question so that I know that there is a question. And we will have Q&A breaks where I'll moderate the questions and give the floor to you then as well. If it's an urgent question, also feel free to just write urgent. So if it's a clarification question, that's important to not wait too long. Then it's a pleasure to have Xiao here today. She's a graduating or finishing PhD at UNSW at the School of Risk and Actuarial Studies. And currently actually also a research actuary at Med Noise Consulting. And I think a couple of her colleagues are here today as well. Her supervisors are Professor Mike Sherris, Dr. Jennifer Alonso Garcia, and Dr. Jonathan Sivei, who I think also co-authors of the paper that she's presenting today. Xiao has been a student at Wisconsin Medicine and also Johns Hopkins, and has various certifications from also several actuary and financial institutes. So I think she nicely uses both practice and academe in her work. So it's a pleasure to give you the floor, Xiao.
Yeah, thank you, Inka. Thank you very much for the kind introduction. So good afternoon, everyone. Thank you very much for coming and listening to my presentation online today. I'm Xiao. I'm a graduating PhD student in UNSW, and my supervisors are Professor Michael Sherris, Jonathan Zui, and Jennifer Alonso Garcia. I've received lots of support from CEPAR since the beginning of my PhD journey. So I will give a short presentation on my third research project, the deep reinforcement learning for variable annuities hedging. So the terminology might seem a little bit difficult for those who do not typically work in this area, but just think about basically using the newest machine learning algorithm to hedge the variable annuity portfolios, like a long-term financial put options. So here's the outline I'm gonna follow today. First, I will introduce what are variable annuities and our research objective. The technology stuff will cover in the methodology part. What is deep reinforcement learning, how to apply these algorithms for hedging purposes. And also I will talk about the traditional model hedging all along with existing research as comparisons. And I will present the numerical results in both single individual contracts and portfolio contracts. And then the conclusion will follow at the end. So let's take a look at what are variable annuities. So VAGMBs are typically short for variable annuities with guaranteed minimum benefits. So basically you could see from the picture that there is one type of death benefit, the GMDB, the guaranteed minimum death benefit, that provides a floor amount given to the beneficiaries at the end of death of policyholder. And in addition, there are also 4 types of living benefits. The GMAB, the guaranteed minimum accumulation benefits, GMIB, the income benefits, the GMWB, the guaranteed minimum withdrawal benefits, and the GLWB, the lifetime withdrawal benefits. We'll talk about that later in a few moments. So for now, we see that these type of products are very popular in the United States. People could invest in these type of products with their 401k account, like our superannuation in Australia. And since US has a very huge capital market, the total VA assets were captured around $2 trillion at the end of 2017. And 34% of them are actually equity holdings. And for insurance companies who actually offer these type of products, nearly half of their assets were tied up with guaranteed living benefits. So these are very important to our research. So for GMAB, the guaranteed minimum accumulation benefits, the rider provides a minimum guarantee on the account balance at maturity. So basically, the account value at expiry time T and the guarantee amount G, whichever is greater, will be returned to the investor, just like long-term put options. And we also take a look at the GMWB. the guaranteed minimum withdrawal benefits that allows the policyholder to make a periodical withdrawal of guaranteed amount from the account, basically for a couple of years. So imagine you initially invest $100 a day, and you are guaranteed to get $20 withdrawal each year for the next 5 years. So it's pretty straightforward. So GMAIB, the income benefits, is different from like GMAB. So here, for GMAIB, instead of getting G, you are guaranteed to get an annuity contract to get converted. So basically also called a guaranteed annuity options. So GLWB is very simple, like guaranteed lifetime withdrawal benefits. It's just like an extension of GMWB for the lifetime. So in US current market, the most commonly elected product is actually GLWB. You see that with a 72% election rate. And the GMIB, the income benefits guaranteed annuity options, comes second with the 7% election rate. According to our previous numerous research in CEPAR, like people are really risk averse and tend to choose this annuity type of product when available. But in Australia, probably because we have our very nice government pension system, variable annuity demand doesn't seem as so popular as in the United States. So most companies like AMP, the BT Financial, and MLC, the offering products are more aligned with the GMAB type, like the capital type. At the end of investment term, the investors are guaranteed to receive their capital back. So what's our research objective? So a lot of companies currently rely on the Black-Scholes framework to price these long-term products. And we know that with Black-Scholes framework, we assume the stock basically follows the log normal distribution, which tend to underestimate the tail events when in economic recessions, financial crisis, like we have the COVID-19 situations today, the underpricing risk is very huge. So from a quantitative finance perspective, adding jumps and stochastic volatility to the underlying stock process seems necessary. But in that case, the solutions might not be so easily to be carried out efficiently. For some models like the Levy process, there is no analytical formula for the option price. You will have to do the Monte Carlo simulations. But luckily for some nice models, like the characteristic functions are available in the closed form, we could employ some numerical methods like the fast Fourier transform, cosine transform, this transform to employ the efficient pricing and hedging. So speaking of hedging, a lot of the research has considered Greek hedging, like the delta hedging. Delta is basically the first order derivative measuring the change of the option prices respect to the underlying price. So the delta hedging trading strategy is to aim to hedge against the change in the underlying price. And then we also have the delta gamma strategy, like also consider the second derivative, the curvature, and also the risk minimization strategy, trying to reduce the whole portfolio variance. So why we want to do this AI, artificial intelligence hedging? So with the tech revolution, the machine learning nowadays can handle large amount of data and transform the non-linearities in an unprecedented level. So basically, without naming the equity assumptions, all the Greeks, we don't need to know if delta is the first order derivative, gamma is the second order derivative, or like vega is the instantaneous change respect to the volatility, this sort of stuff. The AI, the artificial intelligence nowadays could perform the tasks entirely in a model-free environment. And the machine learning has proven to be very efficient in dealing with large amount of data. So we're interested to see the efficiency to hedge a large portfolio of contracts, especially the VA contracts. The hedging objective in this case can be more complicated. Rather than like we just like minimizing the variance or trying to maintain the delta neutral, we now could optimize the risk measure, the extreme cases scenarios. We know that the risk measure, the solvency measure, is the value at risk of 99.5%. So if we optimize the risk measure, ask the computer algorithm to seek to optimize the risk measure, we could, have direct impact for the capital solvency framework. So there comes our research objective. We wanted to conduct a study on quantitative finance and deep reinforcement learning. So we wanted to use the new computer learning algorithm to compare the deep hedging versus the great hedging for different VA products portfolios in different equity assumptions. We wanted to show that in long-term VA GMB's modeling, the AI deep hedging is more efficient than the traditional delta hedging, and especially when handling a mixed large portfolios of contract. And we also wanted to see that whether the equity assumptions still matter in this AI model-free environment. So here is the methodology map on a comparison of model hedging versus deep hedging. So we start both with future stock projections with some sort of equity assumptions like the Black-Scholes framework, the log normal distributions. And then for in our research, we consider 10-year products. So with model hedging, we need to evaluate the net liability at time 1, time 2, time 3 to time 9, and then calculate the delta, calculate the Greeks, the instantaneous change respect to the underlying stock price. And then we periodically rebalance our trading strategies and evaluate the hedging effectiveness. But for deep hedging, we just need to specify the input as stock price and the output as the trading strategies, the stock holdings as the tensors. Tensors are just like holders. And then we construct the RN model, the recurrent neural network model, by adding different layers. And then basically for information processing. And then we pass our objective is to minimize the CEPAR, the conditional value at risk, of conditional tail expectations at 5%. Like we wanted to minimize the extreme 5% scenarios, the loss associated with that. And then we start by training the model using the self-iterative algorithm and to find the optimal strategies and as the tensor output. So let's get ready for the wave of tech terminology. So what is deep neural network? So the neural network, the term is inspired by the neural models in biological science. But nowadays, the modern deep learning algorithm is studied in the area of artificial intelligence in the computer science domain. Computer algorithms are nowadays are very developed. They could solve complex data-intensive tasks like the NLP, the natural language processing, and facial recognitions, etc. Although this area is still quickly evolving, machine learning algorithms are generally regarded to extract knowledge from the large amounts of data. So deep learning is basically like extending the machine learning with self-training, like use the previous knowledge for self-updating, self-improvement. So from the diagram, we could see the relationship of artificial intelligence, machine learning, and deep learning. So for artificial neural network, also known as ANN, we have input layer and hidden layer and output layer in their structure. A deep neural network, that's short for DNN, typically refer to the ANN, the neural networks with more than 2 hidden layers. There are many nodes and neurons on each layer to process information. So when did the ANN era end and the DNN era began? It's widely accepted that the game changer is the AlphaGo, who won over the human champion with training in TensorFlow by the Google DeepMind. So a lot of post-2008-16 research can be conducted in the DNN, the deep neural network environment, because it's able to process more hidden layers with extra information than the traditional ANN. So CEPAR in 2019 conducted a little review study. Basically, there are 8 classes of deep learning algorithms applied in financial analysis by now. These algorithms typically are different in terms of how these informations are linked and how the nodes of weights are structured. So for example, there is a deep multiplayer perception, DMLP, and the convolutional neural networks like CNNs. But they find that the most popular one is the recurrent neural network with LSTM. We'll address that later. So recurrent neural network is able to provide better forecasting performance because of their ability to process the time series information. So that is what we use in our research. So in the structure of RNN, recurrent neural network, the previous layer's output can be used as input for the next layer, as well as having hidden states, as to process new information. So basically the output in layer 1 could go as the input in layer 2, as well as adding extra new information with hidden states. In this sense, the input length, the initial input layer, the length or size doesn't play much difference anymore. So the computational algorithm considers the historical output in each layer, but however, it might be more computationally demanding. So LSTM, also known as long short-term memory units, is a special type of RM model. It's also called the gated recurrent unit academically. So a gate function now is added to process, like to control what information is to be dropped, what information is more relevant. So basically we can say that in layer 5, we wanted to drop layer 1 information, and in the same sense, like layer 4 information is more relevant than layer 3. So it's very intuitive structure. So now let's come to the last piece of puzzle, the deep reinforcement learning. Deep reinforcement learning is like a combination of DN and the deep neural network with reinforcement learning algorithm. So reinforcement learning nowadays are mostly model-free. It is aimed to make a sequence of decisions in an environment to maximize the long-term reward. It is considered a third type of machine learning algorithm that different from supervised learning, the classification problem, or unsupervised learning, like the clustering problem. So it is officially become the third type of machine learning algorithm. There is also model-based reinforcement learning, but it's not so popular. So we just know what that involves. So in model-based reinforcement learning, it tends to learn the transitions, the rewards in a traditional way and do the value interaction. So let's say in a Super Mario game, when you eat a mushroom, you grow bigger. And when you touch a turtle or a dragon, you die. So basically, you know what is a transition and what is a reward, and then you tend to, when eat the mushroom when the mushroom becomes available, and avoid the turtle or the dragon, the enemy, at all costs. But in model-free reinforcement learning, you just tend to learn to maximize the value directly. So let's say the algorithm is able to choose any actions, but it's purely based on trial and error strategy. So still in this Super Mario game, we don't define what is a mushroom, what is a turtle, what is a dragon, you eat or not, whatever, it doesn't care. But just like through the trial and error strategy, we release 1 million Marios from the beginning, and they go by themselves and learn how to rescue the princess just by self-iteration. So technology revolution nowadays makes it easier to run these types of simulation. So now let's take a look at our research in VA hedging. So deep hedging framework is firstly developed by Buehler in 2019. So in a general setting, we have the discrete time setting, the potential claims in each time, and trading strategies like the holding of stocks and the cash positions to balance the self-financing. Sorry, is there a question there? Hedging profit and loss can be evaluated by using the portfolio gains minus the claim payout. And we could use the optimal search algorithm to find the optimal hedging strategies. And then we implement this algorithm in the TensorFlow Keras library. So we specified our input as stock simulations, the survival probabilities, and specify our RNN model, the recurrent neural network model, by sequential modeling with some LSTM units. But we wanted to make sure the requirement is the layer nodes have to be larger enough to capture all information. And then we specify how to use the tensors to calculate the assets, how to evaluate the loss, how to evaluate the hedging strategies, and then cast the loss into the array and return the risk measure. And then we train the model by self-iteration. Adam optimizer is like built-in optimizer with the TensorFlow Keras library, and then now output the optimal hedging strategy. So now let's see the traditional model hedging for comparison purposes. So for conventional hedging, we have the fair guarantee fee. Fair guarantee fee is the fair price charged in the non-arbitrage setting. We calculate the net liability in each time using the formula, and then we calculate the model delta using the forward difference method, like the instantaneous change of the option price and of the net liability with respect to the stock price. We also considered other hedging strategies like no hedge at all, or static hedge, you just hold the initial delta and not rebalancing at all, or the semi-static hedge, the frequently rebalance the delta, like yearly rebalance in our case. And we conduct the simulate calculations for GMDBs and GMADBs, like the combination of GMABs and GMDBs and GMWBs as well. These are all fixed-term contracts. We just consider fixed-term contracts for computational purposes in our research. So now let's take a look at the numerical results. For single contract, we consider Black-Scholes framework. The risk-free interest rate is 5%, and the volatility is 16%. The mortality we assume follow the Gompas law. The fair guarantee fees are calculated with the Fourier cosine method, which is available in my previous research. So for 10 years, we simulated 20,000 stock path generations. So here, the hedging loss is provided in the table. The negative hedging loss is actually a gain. So we wanted to minimize the tail loss, which is a positive number. We wanted to minimize the positive number of the loss. So deep hedging, basically you can see the RM model is a deep hedging. The deep hedging is able to find a smaller CVAR, a better risk measure within seconds, coming up a better trading strategy. Because we assume this yearly rebalance, we plot the deltas, like the holding of the stock holdings at each discrete time, in time 1, time 3, 6, and 9, shown here. So you could see that deep hedging, we plot the semi-static hedge as a finite forward different delta, and also the RN delta as a deep hedging in orange. So you could see that deep hedging is mostly aligned with delta hedging strategies. At earlier times, better hedging performance is because of the gamma effect, because option writers are just like shorting the gamma. And then we also take a look at the GMDBs. So GMDBs is like you consider that death might happen in different possible times throughout the term, and then you evaluate a linear series of guarantees. So now the deep hedging algorithms the computational efficiency starts to show. So it can basically beat the delta strategy, so beat the delta strategy with less time. And also, if we plot the delta holdings accordingly, we could see that the deltas, the RN deltas, deep hedging deltas, and the finite different model deltas are quite aligned. And now we tend to look at the GMWB contracts. It's like the periodical withdrawals are available. It's more like the Asian type of contract. So now the RN model could easily beat the delta hedging strategies within seconds. And if we plot the delta, the stock holdings at each different time, we could see that it's quite aligned at the beginning, but it is interestingly show like when it's towards the end of the contract, when the account actually run out of the funds, the delta should be 0 because the liability doesn't change anymore. The insurers will need to make up the payout payment, the periodical payment, no matter how. But the bot actually asks you to invest your cash to positive holdings of the stock, because to bet on the earning potentials in these extremely low prices in the environment. So bot is surprisingly smart in how to minimizing the loss. So now let's take a look at the portfolio contracts. Sorry. The portfolio contracts, because according to the utilization study, most purchasers are 65 years old. So we construct our portfolios like this by giving more weights to people in their 60s and 70s. We also consider some more complicated equity dynamics, like Levy models with jumps and stochastic volatilities. We do not typically go very further on equity details in this research, but we just know, like for your knowledge, that products are going to be more expensive when jumps and the stochastic volatility are considered. Like the base, they consider Heston stochastic volatility with Merton jump. You could see that these fair guarantee fees are more expensive in the Black-Scholes cases. So we conduct the deep hedging with these portfolios in different equity market assumptions. Basically, I stop the algorithm after they reach the comparable level of 95%, like 5% scenario, extreme scenarios of the conditional tail expectation at the same level. So what are the key observations? So with the 95% CVAR, the 95% VAR of the Black-Scholes has the highest cutoff. So basically, with the same kind of tail expectations, the cutoff level with Black-Scholes is the highest. So that means the Black-Scholes still has the lightest tail. And for the solvency measure, so solvency 2, the suggested measure is 99.5% value at risk, which means the cutoff level, the extreme scenario that's going to happen in 1 in 200 adverse scenarios. The Black-Scholes is the lowest. The Black-Scholes here, the Black-Scholes is only like 1490 something. Well, all other models suggest a VAR measure, 99.5% VAR, greater than 1600. So Black-Scholes takes the least computational time, as we can see from the computational time from the table. So we conclude that equity model risk still requires careful inspection in this sense, even though we input the simulated stocks as tensor in a model-free environment. So let's take a look at our final conclusions. This paper compares the VA/GMB's hedging using the model-free deep reinforcement learning versus the model-based Griggs approach. So for single contract, we can see that deep hedging is able to beat the traditional Griggs hedging within several seconds. And the Black-Scholes assumptions tend to underestimate the tail risks. And the Solvency 2 measure of the risk-based measure, the 99.5%, like measured in 1 in 200 adverse scenario, the value at risk, does not take into consideration of the tail loss magnitude, the size. And the equity assumptions still play an important role in the model-free hedging environment, and the insurance providers are still suggested to use multiple equity models to consider to reduce their extrapolation risk. So that's all. Thank you very much for listening, everyone.